Good morning to the company's CFO and his assistants. I am the newly appointed CEO. As you know that the company is under incorporation, and I would like you to explain how the company can issue its stock and sell it to shareholders. If this is outside the scope of your expertise and it needs us to hire an external expert, we will do that. Excuse me, Mr. CEO. Why did you start offensively in our first meeting with you? What do you think we are? Do you think we are a group of salespersons who sell kid diapers, or expired medicines in Souk Al Goma and Souk Al Tunisi, or sell pets and wild pigeons in Al Saida Aisha Souk? Most of us are CPAs, or CMAs, and of course we are good at what we do. As to your question, I can inform you that stock is issued at par value. However, it may be sold to shareholders at a higher price than par value. The par value of stock is an arbitrary amount assigned by the issuer, I mean the company. Common and preferred stock are reported in the financial statements at the par value. That is very fine. First of all, outsourcing services is not against any work team in the company, and sometimes it's the appropriate way to do things effectively and may also be efficiently. Back to our subject matter, we need to know how the stock issuance transactions are to be reflected in the books of account. There are two scenarios. 1. The par value of the stock is the same as the selling price to shareholders. 2. The selling price to shareholders is higher than the par value. Such selling price can be determined based upon the market conditions at the issuance date. In the scenario 1, cash is increased or debited in the appropriate stock account. I mean common or preferred stock is increased or credited for the total par value of stock issued. What is about scenario 2? In scenario 2, cash is increased or debited and the appropriate stock account is increased or credited for the total par value of the stock issued. An additional paid in capital, I mean paid in capital in excess of par, is increased or credited for the difference. I appreciate. Would you give us an example that explains the two scenarios? Fine. Assume that the company issued 50,000 shares of its $1 par value common stock. The market price of the stock was $17 per share on the day of issue. If the market conditions do not allow the company to sell the stock in excess of its par value, the journal entry in this case is to debit the cash account in $50,000, 50,000 shares by its par value of $1, and to credit the paid in capital, common stock account at $50,000. What if we sell the stock in excess of its par value? In this case, and referring to the example given, the journal entry is to debit the cash account at $850,000, being the 50,000 shares multiplied by the market price of $17 each, and to credit the common stock account at $50,000, being the 50,000 shares multiplied by its par value of $1 each, and to credit additional paid in capital account at $800,000, being the difference between the market price of $17 and the par value of $1, which equals $16 per share multiplied by the 50,000 shares. We also need to know the accounting treatment of direct costs of issuing stock. Direct costs of issuing stock such as underwriting, legal, accounting, taxes, registration and other related costs must not be recognized as an expense. Instead, they reduce the net proceeds received as additional paid in capital. Thank you for your valuable information, and I am sure now that you and your team will perform in an excellent way.